Thanks everyone for joining us. This is our February edition of the Situation and Outlook, our monthly webinar series that we've been putting on now for several years. I'm going to kick us off today and followed by Frayne Olson, Tim Petrie, and I think some of our other panelists might have some stuff to present as well. So I'm going to go ahead and share my screen and get going. All right, folks, so what I'm going to talk about today is the USDA's February forecast for net farm incomes nationally. And this report comes out, or a version of this report comes out twice a year, once in February and once in September, and they'll do some revisions and alterations. So what you'll see for 2026 is a projection. Then they update the projection, for instance, for 2026 in September, and then they kind of finalize the projection February of 2027, and that's what they did with 2025. So I'm going to start with our net farm income numbers from USDA. Well, their net farm income numbers, I should say. So the chart on the left is from September of 2025, so the one right before this. And what they were expecting was $180.7 billion net cash income and about $180 billion net farm income. And then I'll turn your attention to the chart on the right. This is what the projection was, or the revision was, for 2025. Is down here. I actually have this arrow pointed at the wrong one. It would be this one right here. And it's $154.5 billion. So significantly lower than this 180 almost, almost $25 billion in net farm income lower in 2025 than what they projected in September. A lot of that having to do with, what commodity prices did there in the fall, and essentially the lack of movement forwards as well. And then the projection for 2026 then is $158.5 billion. So slightly higher than this next year than last year, and we're going to kind of go through some of the reasons why. Okay. So when you look at, they break it out, and these charts are straight from the report if you want to go read it. But they have U.S. farm sector cash receipts, and these are adjusted for inflation. And again, the projection, that the reason 2026 has an F is it's a projection, forecasted, in other words. So cash receipts for crops is expected to increase about 1.2%. And cash receipts for livestock is expected to fall 5.8%. Now, when they say crops, I know we in North Dakota are thinking our pulses, soybeans, corn, and wheat. They mean all crops, fruits and nuts, melons, vegetables, everything. Same true for livestock. In North Dakota, we're thinking cattle and calves. They're talking about poultry, eggs, turkeys, dairy, the whole ball of wax. So we'll go through some of those individually as we move forward. But basically, crop cash receipts, just a very slight increase this year, and then cash receipts for livestock down about almost 6%. So let's look at the crops, some of the major crops individually. Corn, cash receipts for corn are expected to increase a little bit, just a couple of $1 billion total. If you look, the light blue is 2025, and the green is 2026. Soybean expected to be about the exact same. I mean, that's as close as it gets, no difference. As far as crops that we care about, wheat's expected to decrease in terms of cash receipts. Now, because a projection that cash receipts are going down doesn't necessarily mean it's because commodity prices fell or yields are expected to drop. It also could be that there's less of it actually planted, because this is not a profit measure. This is just cash receipts. So if we, for instance, planted less wheat, if prices and yields stayed the same, we had lower cash receipts. This is just what they're projecting on that. On the livestock side, like I said, it's mixed. If you look at cattle and calves, that's actually projected to go up in 2026 from 2025. The big drop in livestock, general livestock cash receipts, is in eggs, going from 26 billion down to almost 9 billion. And then dairy going down from almost 49 billion to 42.5. The rest of them staying either slightly increased or very slightly decreased, hogs and broilers. But eggs down significantly, dairy down significantly, and they're down enough that this big increase in expected cash receipts for cattle and calves couldn't offset it. So that's why livestock's down on a percentage basis, despite the fact that cattle and calves are expected to be up. And then we look at overall production expenses. They're expected to increase $4.5 billion, and that's adjusted for inflation. The actual nominal number is slightly higher, but some of that's inflation related. And it's overall not actually a huge increase. It's less than 1 percentage point total, 0.9% overall cost of production increase. And this is for all products. This is livestock and crops from 25 to 26. And where you're seeing livestock and poultry purchases up. That's a lot of that being high calf prices. So if you're a cow-calf producer or a feedlot of any kind, you're buying really expensive calves, and that's expected to be even higher than the year before. Feed costs a bit lower, commodity prices down perhaps. Fertilizer, seed, pesticides, most of that down slightly, very slightly, but fairly. Taxes and fees up a little bit, rents up a little bit, and of course, labor costs expected to increase. Now, direct government payments. Okay, so this is obviously a pretty big one. Ad hoc payments, mostly from, every year we basically had ad hoc payments. This most recent round that is going to be counted in 2026 is from that Farmer Bridge Assistance Program, and that was about $23.9 billion. Then the other reason that we're going to have a big increase in farm program payments in 2026 compared to 2025 is the alterations in ARC and PLC. So we look back like last year, ARC and PLC didn't pay out much at all. 2024, just a little sliver of ARC and PLC payments, a bit more in 23. You can see ARC and PLC this year is going to pay out a significant sum of money to the, right around 15 or so billion dollars. So that's a pretty big change that's happening on top of this ad hoc Farmer Bridge Assistance Program that came out for this most recent year. And so here's kind of what I was looking at in that data. So, we see the charts, we see that net cash farm income and net farm income is supposed to be roughly the same last year into this year. And when you dig into the data, there's some troubling trends that are kind of emerging as we're going through the last half decade or so. So I turned the attention, and I'm using 2021 as a benchmark because 2021 it wasn't a record-setting year like 22 was, but it was a solid year. It was certainly one of the better years we'd had since 2018. Net farm incomes were in, pretty strong. In fact, I go back and look at some of those. Let me get back to the very beginning slide. 2021 right here, this was a pretty solid net farm income year. I just want to show it here. 22 was the record, but 2021 was a pretty strong year, and it was comparable in net farm income to 2012 and 2011 nationally. So back to this one. So 2021 crop cash receipts were $246 billion. In 2024, $245 billion, so about the same. 2025 down a little, a couple of percentage points. 2026, the projection is $241 billion. So not very far off that 2021 number, which again was a pretty strong net farm income year. Livestock cash receipts in 21, $196 billion. In 26, $274 billion. Big increase there, almost $80 billion in livestock cash receipts. Then government direct payments in 25 was $30 billion, and in 26, $44 billion. Okay, a lot of that we already covered. Now we look at total expenses. In 2021, our total expenses were $371 billion. Okay, so this is net, or this is crop cash receipts. Okay, and you add into livestock, 196, and this was total expenses, 371. Expenses in 2024, $456 billion. 2025, 473, so $100 billion more in expenses in 25 as opposed to 21. And then 478 billion projected in 2026. So you look, and in just 4 years or so, 5 years, 4 to 5 years, our net farm incomes have remained pretty stable, fairly flat, or not net farm income. Our cash receipts have stayed fairly flat with the exception of livestock, which has actually gone up. But our expenses have increased, about $100 billion in total nationally. And in 2026, 29%, if those projections are correct, 29% of net farm income will have come from government payments, either ARC, PLC, or the ad hoc programs, as well as a little bit of conservation. And then if you separate ad hoc out by itself, that made up 16% of net farm income, will have made up, if the projections are correct, 16% of that will have come from the Farmer Bridge Assistance Program. And so I guess what I'm getting at is I'm going through here is we're just seeing these production expenses, or we've seen these production expenses increase dramatically, $100 billion in the last 5 years, while incomes, gross cash incomes, especially on the crop side, have stayed flat. And so, we're always wondering, do we have a revenue problem, or do we have an expense problem? Because on one side or the other, if you're a production person, and when you look at this here, it's hard not to argue that we have an expense problem. The production expenses relative to our incomes have just grown too fast, and I just don't know how sustainable that is moving forward. And we're going to hear from Frayne here soon on commodity prices and things like that. But I guess I would argue that incomes, gross cash receipts haven't gone down really for crops much at all. They've been fairly stable. And I took 2022 out of that because that's the one year that they were pretty high. But the other 4 or 5 out of 6, they were around the same amount. It's just that those expenses have gone up 25, 30%, 40% in the same amount of time, which has really put a strain on the bottom line and the margin. And without government program assistance, it would be pretty dire, especially when you consider how high livestock prices are, which is offsetting a good portion of the net farm income problems that we would be dealing with otherwise. So with that, I'm going to turn it over to Dr. Frayne Olson. Hopefully he's got some news to help offset what I just said. But again, that production expense side of things is something that we're watching very closely, and I don't have a great solution for you right off the top, but right now I'm kind of coming at a lot of this from the fact that we have an expense problem more so than an income issue.
All right. Thank you, Brian. Let me share my screen real quick here, make sure that everybody sees that. All right, fantastic. So good afternoon, everybody. Frayne Olson, crop economist, marketing specialist with NDSU Extension. We'll talk a little bit about the information we got in the February WASDE report. But I'm also going to talk about a few other things as well that are in the news that you need to be aware of and be watching pretty closely. So just to summarize very quickly, the WASDE itself, the February update was relatively neutral for corn, soybeans, and wheat, unlike the January report, which had a little bit of shock value in it, but the February one's pretty mundane. And I'll go through those numbers in just a minute. Some small changes, nips and tucks here and there. I do want to spend a little bit of time on some updates on some global trade agreements. That continues to evolve and kind of mature as we go through time. I also just want to remind everybody about the Supreme Court ruling we are expecting in the use of IEPA. So I'll go through that in just a minute here as we move forward. So let's begin. Just an update on forecast for ending stocks, and anybody that's heard me talk over the last several months, I've spent a lot of time on this ending stocks numbers just because it does influence market psychology. The tighter those inventories, typically we see higher prices, a lot more price volatility. The bigger those inventories, we tend to see lower prices, a lot more stability. So let's compare. Again, usually when you look at the top line, which is the trade estimates, that's the number that the market analysts and traders were expecting to see. The highlighted blue line on very top. We see the highest trade estimate, the lowest trade estimate. The highlighted black row towards the bottom is from last month. And then we look at the red one on the very bottom, which is the information we got out of February. And so when we compare that, usually I compare the blue to the red, just because this is what the trade was expecting to see versus what we actually got. So again, going with wheat, we're expecting ending stocks to be trimmed just a little bit. We actually had a small increase. Most of that was because of a slight decrease, a slight decrease in the forecast for wheat exports. So not major changes, but again, just putting a little bit more downward pressure, a little more negative viewpoint into the wheat market. On the corn front, we were expecting a slight increase in ending stocks, or basically unchanged, from the February report. We actually got a slight decrease. Again, USDA made very small adjustments, an adjustment upward now for corn in our export pace. And so when you compare what USDA is forecasting for the year-end numbers versus where we are today, right now we're well ahead of the pace that is expected for the year-end total. So I think USDA is starting to adjust and compensate for that fact that we've had some very, very good corn export sales so far, and they're recognizing that in their total 12-month forecast. For soybeans, basically unchanged. The trade wasn't expecting any major changes. So again, a small decrease in wheat exports, which brought our ending stocks up. A small increase in corn exports, which brought our ending stocks down. Again, nothing that with great shock value, but it is something we're watching closely. Turning to South America, again, when we look at what USDA is forecasting for total production for corn, soybeans in both Argentina and Brazil, I'll start with Argentina very quickly. Essentially, no changes in either the corn or soybean production numbers. Now, this is again total tons or bushels produced. There is some dryness starting to show up in Argentina. It's kind of been in the news off and on. They did get some rain showers late last week. Over the weekend, it did help, but now the heat is returning again. So the longer term concern is, will Argentina be able to reach those production numbers? They're in the middle of their growing season right now. Still a little bit too early to tell. My challenge with this from a pricing standpoint is Argentina is important, but not nearly as important as the Brazilian crop. So will it add some support to U.S. grain prices? Yeah, it will, but is it going to be a major game changer? Probably not. It would take a major, major event in Argentina to get a price response here in the U.S. Turning to Brazil, again, on the total corn production numbers, basically unchanged from last month. We weren't expecting any major adjustments, just simply because the second crop corn, or the safrinha crop, which is just now being planted, is just now being planted. So about 70% of the total corn production in Brazil is this second crop. It's just now being planted. So there's still a lot of uncertainty about what the total size of the Brazilian corn crop will be. Interesting enough, on the soybean side, USDA did increase their forecast for total soybean production out of Brazil. This number now at about 180 million metric ton is really synchronizing pretty well with what the trade and the market analysts have been talking about for a month or two. So I think the USDA numbers are now kind of synchronizing and catching up to what the private estimates were coming out of Brazil. Again, nothing earth-shattering, but a few things just to remind everybody. Again, Brazil is expected to have a very, very large soybean crop, which again plays into our marketing plans here in the United States. So let's talk about trade issues. A couple updates on the U.S. front. U.S. and India have confirmed that they have at least a framework agreement. We don't have all the details. There's still some pieces being developed out of this. I don't want to read all of this. I do want to focus on primarily what's going on the agricultural front. So if you look at the bullet points underneath, India has agreed to reduce some tariffs on nuts, fruits, vegetables, wine, and some spirits, basically alcohol. So we will be able to sell some of our U.S. products into that Indian market. Unfortunately, there was really no mention of U.S. access to India's markets for rice, beef, soybeans, sugar, dairy, some of these major commodities. In fact, at one time, the pulse crops were on this list, but again, they have now been taken off. So there's been some pushback within India. I read some reports this morning that some of the Indian farmers are getting very upset and frustrated with their government, in particular together on trade and agricultural trade issues. And that's something that within India, if you're President Modi, you need to have that support politically from the Indian farmers to be able to do your job. And so agriculture in India is a very kind of contentious topic. Personally, I'm not expecting any major movements on this, but it is something to be watching. I'm really hopeful that we'll be able to get some adjustments and changes, be able to, in particular, ship maybe some more U.S. soybeans, potentially some more U.S. corn into the Indian market. But again, it's still all up in the air right now. I also want to make sure that everybody understands India has banned the use of GM food for food crops, specifically for food crops. We're not really sure. I've not been able to confirm about the feed crops. So again, primarily soybean meal, corn coming into the Indian market is primarily animal feed. I'm not sure what the rules are within India for the use of GM feed crops for livestock. So again, a few pieces. I'll try and keep you updated as I learn more. Next, when we move to Argentina, U.S. and Argentina have finalized a trade agreement. A lot of this is about reducing the existing reciprocal tariffs between the United States and Argentina. On the agricultural front, most of that has to do with beef and beef products. So there was a tariff rate quota for Argentine beef coming into the United States. That quota level was increased, i.e., it's a little bit easier to get Argentine beef into the U.S. Again, that's primarily what we would consider hamburger meat, not necessarily the primal cuts. And now Argentina, to reciprocate, has also then allowed the increase of U.S. beef imports into Argentina. Again, those would primarily be those those more expensive prime beef cuts. So there's a difference between the quality and type of beef being imported and exported between the countries. Again, there's a lot of dynamics in there, but it's really mainly on the beef side and the animal product side. We don't have a lot of details again about other agricultural products other than what's happening within the beef front. U.S. and China, there were some announcements this morning again. There was some, I guess, supportive news, and I know the soybean market today has responded to that. The U.S. and China are expected to extend their current truce in tariff or the tariff disagreements, according to a Bloomberg News report. Again, just as a reminder, U.S. President Trump and Chinese President Xi are scheduled to meet in Beijing in April of 2026. So it's just coming up in a month or two for some more face-to-face discussions. Again, there's some optimism building now that these trade tensions between the U.S. and China are starting to kind of dissipate a little bit, which again is putting a little bit more spark into the soybean market in particular. Now, in the same kinds of reports that came out this morning in particular, apparently again, Bloomberg News is reporting that President Trump has privately been considering exiting the USMCA or the U.S.-Mexico-Canada agreement, the old NAFTA. Again, there's no confirmation of this, but that's also one of those things that's raising some concerns about trade and what these trade negotiations with the U.S., Mexico, and Canada. Right now, USMCA is in this mandatory review period before a possible extension in July 1. And so there's a lot of kind of behind closed doors discussion going on about a reviewing of where we are within the USMCA, what that's going to look like as we move forward. Again, we have tremendous amount of agricultural trade between the United States and Mexico. Mexico's our number one corn buyer, our number one wheat buyer, our number two soybean buyer, our number two spring wheat buyer. So it's very, very critical for at least the crop agriculture within this region. So we have to be aware of that. We also have a lot of agricultural trade with Canada, not only for fertilizer and canola products, but also for some machinery products. So this really, in my opinion, will have a pretty big influence on our region. We need to be paying attention to it. Again, my goal and objective is to try and keep you current on what's been going on. Shifting a little bit to some of our other trading partners, there was probably heard about this recent announcement that Canada and China have a framework agreement. If you notice down on the bullet points, I'll focus on on what this might mean for U.S. agriculture. There has been a significant reduction. The Chinese have significantly reduced the tariff on Canadian canola Just for a reminder, Canada, the largest export customer for canola out of Canada is China. They buy a huge amount of the whole seed that goes into the Chinese market to be crushed. So that tariff went from 76% down to 15%. There was also some lawsuits or some discrimination tariffs that were put on U.S. canola meal. Again, China is the largest buyer of Canadian canola meal. So this agreement now really has helped support canola prices, and I think you've seen that happening in the futures market. China has come in and started buying some additional U.S. canola. They have been kind of backfilling some of their canola needs through Australia. The Australians are now trying to be as competitive as they possibly can with this canola from Canada. So an update there. Just also as a footnote, canola oil. Most of the canola oil that Canada exports and produces comes into the United States. So even though that 100% remaining tariff on canola oil into China it continues, China is not a really big purchaser of the oil products. It's mainly the whole seed as well as the canola meal. Moving to the European Union, the EU now has two new trade agreements, one with a group called Mercosur. Mercosur is the countries of Argentina, Brazil, Paraguay, Uruguay, and Bolivia. It's taken about 25 years of negotiations to get this agreement in place, but the agreement has now been signed. And so the European Union is looking to diversify their portfolio of who they're trading with, not only in agricultural products, but also in other commodities as well. So just realizing that now the European Union has stronger trading relationships with the South Americans. Not long after the agreement with Mercosur countries, there was also an announcement that EU and India has confirmed at least a framework agreement with India. And again, agricultural products now, specifically soybeans, beef, rice, dairy, were not included in this agreement. It really focused on cars, industrial products, electronics. But again, the European Union is trying to diversify their supply chains and become less direct reliance on the United States. Just one more comment really quick about IEEPA, which is this the kind of the provision that President Trump has been using to do and incorporate all of these reciprocal tariffs. The Supreme Court is expected to rule on that very, very soon. I'm at a national conference right now. There was a session that was specifically on IEEPA and what the implications might be for that. We'll have to wait to see. We are expecting, the rumor right now is probably next week, the Supreme Court will be off of their recess. We'll be able to come back and we'll start getting some more information about what this trade, what tools the president has within his toolbox to be able to negotiate and use tariffs as well as renegotiate these trade agreements. So again, please be watching for that, and there's going to be, in my opinion, some pretty significant implications from it. What's happening in the markets? I pulled these charts very quickly before I came on at about 12:30. You can see that the corn market has recovered a bit from the lows we saw earlier this year, in 2026. We're still within a pretty tight trading range. Some of the trade news has not been as direct impact on the corn market as it has on the soybean market. So from a corn marketing standpoint, we're still solidly within this trading range. On the soybean side, because of the expectation that China will come in and buy some more U.S. soybeans, there have been some confirmed sales of U.S. beans into the Chinese market. It's putting a lift into the soybean market. I know that there's a lot of soybeans being sold right now. Again, at the national conference I'm at right now, talking to farmers from across the United States, and there's been some very, very long lines at crush plants as well as at grain elevators delivering soybeans for sale. So my caution to you is that yes, we've seen a nice recovery, but the cash market in particular, we're seeing some soybean movement, we're seeing some soybean sales into the supply chain. I think, if you have some soybeans for sale, please be looking at this as an opportunity to try and clean up the old crop sales, getting ready for the 2026 crop. On the wheat front, again, relatively quiet. We are now starting to get to the upper end of the trading range. It'll be interesting to me to see if in the next, we'll have trading day on Friday. Monday is a federal holiday, so the futures market won't come back until early next week. I do think some of this is positioning coming into this long weekend. Again, we're still within the trading range. We're on the upper end. I'm hoping that we do get a little bit more lift in the wheat market to break through some of those resistance levels. We'll just have to wait to see how that plays out. So with that, I will stop sharing and I will turn things over to Tim Petrie. Thank you very much.
Good afternoon, Tim Petrie, Extension Livestock Marketing Specialist. As I promised last time, the new cattle inventory report came out on January 30th, and I said I was going to cover it. And last time I said, the main thing we're interested in, of course, is has any rebuilding started in the beef cow herd? And so we were interested. You see those two arrows there in what the number of beef cows we have, and also the number of beef replacement heifers. I've been saying that, and many others have also said that the expectations were for beef cows to be somewhere from a -1 to a +1, and the same on replacement heifers. And so the report was not a surprise. I'm not going to go through all these numbers because I'm just interested in the color on the right-hand side of the change over last year. And so a lot of red on the chart means we've got for many market classes, dairy is the exception, and beef replacement heifers is an exception there too of fewer cattle. So that's going to be supportive to prices. Actually, the beef cow number came down 1%, and again, that was within the range of our expectations. And the beef replacement heifer, the second arrow down there, we're up about 1%. So, kind of what's expected. I thought maybe beef cows might not be down that much, but again, I'm coming from a North Dakota, and we'll see when we look at the North Dakota numbers that, expansion has been occurring, but the weather just hasn't been conducive, and more on that in a minute. So here on top then is the number of beef cows that we have and on a cyclical basis, and then where it is, this is the 7th year of decline in beef cow numbers, so longer than usual decline there, but again, the weather hasn't been favorable, and down to 27.6 million head of beef cows there, quite a bit below where we were in 2014, the last time we had record high prices. A couple other numbers that are kind of something to keep in mind is in 2023 we were down almost a million head, or you add the 24 onto that, down a million head, but we are making up for that, and I'll show you another slide in a minute. We are making up for that in terms of adding weight to steers, and so herd rebuilding will start sometime, maybe even this year, because we have more beef replacement heifers, but it's going to be very, very modest and not quick. And there are a lot of other things coming into play here besides weather. And we're still in drought in quite a bit of the country that I'll talk about in a minute, but there's many other things, all the uncertainty and so on. And Frayne mentioned trade agreements and so on, and government policy and high production costs that Brian mentioned and so on. So there are other issues there. But anyway, we've got a very low beef cow herd, which is supportive to prices. And on the bottom then, yeah, we did pick up replacement heifers a little bit, but the questions I continually get as we go back to the previous low there in 2014 and 15, how quickly we were able to bring numbers up, and then by 16 prices down. And so is that going to happen again? And even though our beef replacement heifers were up a little bit on January 1st, 4.7 million there, still much below what it was when we did the faster accumulation or more numbers back in 14 and 15, because back in 14 there you see we had 5.56 million head, and then by 15 we had 6 million head, and we're down there still at 4.7 now. So we just don't have the replacement heifers on hand to really quickly rebuild the herd, and then there's the weather and everything else to consider. So, we won't, like I said before, we won't, when we do increase, we are not going to go back up to 31.6 million head. We will do some more, but we don't need the additional cows because we're putting it on weight on steers. So remember, there 23 and 24, we got rid of about 1 million beef cows or so, but in 2024, we made that up. We slaughtered the equivalent just in pounds. This isn't in cattle, but in weight on steers and heifers, the comparable of 25,000 more per week, or 1 million head more for the year, but we didn't have the animals, but we had the weight. And then again, the same thing last year. And look at this year, we're starting up again. So more weight, more weight. We don't certainly need as many cows. So that's maybe another thing that's holding back. USDA right now is predicting beef production this year to be very close to what it was last year. And it's beef production which determines prices for us. And so, that's an important consideration when we are rebuilding beef production. It's just we're not rebuilding the beef cow herd. So here's the numbers. On the top again as last year. I like to go back that because there seemed to be more interest then, and then it got dry on us. The big beef cow states are showing there in purple. We just start in Texas, come up Oklahoma, Missouri, Nebraska, South Dakota, and we're in 8th place. And last year, this is the change in beef cow numbers from 24 to 25. Last year, 6 of those top 10 states increased beef cow numbers, including Texas, Oklahoma, and up here, Montana and North Dakota, we increased numbers. So there was interest in herd rebuilding. In fact, we did it in those major states. But they did fall 120,000 in the U.S. Now we come down to what happened this year. Change in beef cow numbers from January 1st, 25 to 26. We did go down 285,000, but for those top 10 states, only 3 of those increased numbers compared to 6 last year. North Dakota increased, and Oklahoma and Florida were the 3 out of the top 10. Interestingly enough, North Dakota was the top increase in beef cow numbers last year. We went up 21,000 head, and we went up 10,000 head the year before. So we're in the rebuilding mode up here, and it's because of weather. And then we come over here. Minnesota was the second to us leading increase in beef cow numbers. So it shows that, where there's it's raining and there's some forage, that there is some interest, but some of those big states again are not, down in Texas and so on. And so we look here, here's what USDA puts out when the drought monitor comes out. And again, the dark green is where the cattle are. And you see, I didn't bring the drought monitor from the day down, but this shows it, that, Texas is getting very dry, Oklahoma up through Missouri and so on. Those are big cow calf states, and Nebraska as well. And so the drought there, down here, a third of our cows are in drought right now. Again, that can change. And I know you folks out in western North Dakota, it's dry out there. There's, burn ban warnings and some out there because you did have a lot of forage, but not enough snow to pack it down. And I know it's dry out there. I'm not showing up in the drought monitor. And so, I was just on a conference call today with my counterparts in Texas and Oklahoma and Kentucky, and drought is very much of a concern there. And they are thinking we're in the banana belt up here too, but it's getting dry, particularly in western North Dakota here. And so we're going to need spring rain. So that's really putting a lid on herd rebuilding, and we're going to need rain, and hopefully that does occur in the spring. Here's the North Dakota numbers then, similar then on the top. there's the cycle. And again, we bottomed out in 2024 at the lowest number we'd had for many, many, many years at 860,000. Back in 2012, we had 862,000. But again, 10,000 last year and 1,000 this year, so back up to almost 900 cows. And again, we've got more replacement heifers in North Dakota here. We were second in the amount of replacement heifers we have, only behind Texas. And so, that it's just that, North Dakota has really bucked the trend on herd rebuilding. So let's just get into quickly look at the prices like we usually do. And again, those of you that have been on this before, you know the colors and so on, and red is a current, and you've heard me give the spiel of increasing cyclically and so on. So let's just go on fed cattle here to begin with. Again, we're starting out up there at this year, we're right now at over 240 and significantly higher than last year. There's yesterday's futures closes, and again up in the 240 area. USDA is our last year. Our average price there since we started low was about 224 USDA, and the WASDE that just came out on Tuesday is predicting a 240 on fed steers. So coming across here, the futures market is about right on that too at 240, 242 there and 240 across. But again, beef demand is excellent. We are still going to have a short supply, but probably the biggest question there is beef demand. If on the consumer side is that going to hold? And so far, that looks like it will. So, the two biggest things that affect feeder cattle most are fed cattle prices, particularly those distant futures for fed cattle when the feeder cattle would finish when they're being sold. So that does look promising to prices. And then the other thing is corn, and Frayne just went through that of the corn situation. Just a little bit then, we had that big decline in prices due to the speculators bailing out, and the president saying is going to reduce beef prices and so on. So we had that particularly in the futures market, a big drop. And, seasonally, we usually do go down after September, October on the heavier weight yearlings a little bit there because a lot are being sold. But it just, you've seen this before, but interestingly enough, the CME cash index is this green line, and that's just all the 7 to 899 weight feeder steers sold all the way from North Dakota down through Texas, where there's a USDA market reporter. And you can see there that we're right back up to where we were in October. Now that we're trading fundamentals again with the short supply, and feedlots are not at capacity, and really after cattle. And then, as Frayne mentioned, we got a huge corn crop, and that's put high moisture corn in Nebraska is put in bunker silos, and they have to feed it to cattle or else haul it out. And so they're after calves, cattle there again. So our prices are right back up to where they left off there in October. And so looking at the different market classes, here's calves. 550 to 6 weight calves last week averaging basically 482, the weekly summary. And again, there's a wide range in calf prices at the same markets for all the different factors that can affect them. But, from 460 up to over $5 there, but an average of 481. But just look at how much higher calf prices are because we're in such short supply of them, compared to last year. And, the expectation, again, we're going to have fewer calves to sell this year. And as long as fed cattle hold and demand holds, we'll be in good shape there. I've talked about this many times, so, don't want to spend a lot of time on it. The reason why calf prices were so high last fall when usually the ground seasonal is everything possible that could go right went right. We had strong fed cattle prices, again, a short supply. The Mexican borders closed to 25 to 30,000 calves would be coming across every week, and that's still closed, and they're still having cases down there, so there's no indication that that'll open up very soon. We retain more heifers, so they, as you saw on the chart, so they didn't go into the market. We had really good winter wheat last year, but it's getting dry down there, and now, and we had new feedlot capacity, low corn prices, the Corn Belt buyers, again, like I mentioned, they're in here because corn is cheap and they're walking it off. And we sold a lot more calves up to Canada last fall, double the amount that we usually do. So just moving ahead, when we get to next fall, what if some of these things, we're still going to be cyclically high and still have good prices, but they would not have to be that high if the Mexican border could open up by then. And, if it's dry, maybe have less heifer retention. All remains to be seen. Maybe not a good winter wheat crop. And, what happens to the corn crop? Do we have, still plant a lot of acres, or is it dry there? And all those issues, could pressure prices in the fall like they usually do, but from a cyclical standpoint, then still looks favorable. So, I don't know what happened here. Anyway, I was about done anyway. Just if you can see this, medium and large feeder steers, the same story there. They're just quite a bit higher than they were last year. So I guess, did I stop sharing? And okay, I think, Ron, are you going to talk about budgets now?
Yes, I am.
Okay, turn it over to you.
Okay, yeah. Good afternoon. Ron Haugen, Extension Farm Management Specialist. I'm going to talk about our projected crop budgets that we just released and a few other tidbits in just a short few minutes here. Here's the headline: NDSU crop budget projections show low returns for 2026. Not a surprise, I guess. I wanted to emphasize that these budgets vary a lot by the crop and by the region within the state. And remember now, every farmer has its own situation. These are only a guide, but there's something to look at. Also remember that these are economic budgets. Anything above zero is good. The bottom line is return to labor and management. We do not account for risk either, or yield variability in these projections. Okay, so if you got a zero budget and you basically worked all year for nothing, and sometimes that happens. Also, we do not include any government payments, so that would be, you want to add that to your projections, whatever payments you may expect. Here's the way we break up the state into 9 regions. Eventually, I'd like to get this down to 6 regions. At one time, there was quite a few different cropping practices in these various regions. Now things are pretty much done the same in larger regions. So, as Brian talked about earlier, talking about costs, he says costs are the problem. And I agree with him on a macro level. We've got these high costs that we're stuck with. And with all these ad hoc payments, there's no incentive for costs to come down. But from my level, the farm level, the micro level, we have these high costs, and how are we going to make it through the year? So I call it a revenue problem from my perspective here. So we've got 2 opposing views here. Now, as far as the 2026 costs go, there was a few bright points. Diesel, we put that in 10 cents cheaper than the year before. Seed prices are pretty much flat for most crops. Interest on operating loans, we put that down about 0.5%, which is, we called around to various banks, and that's kind of what the consensus was. Nitrogen is up, phosphorus is up a little bit, potassium is down. Crop insurance is flat to down, the premiums that you pay, because the new crop insurance subsidies would help that out. And machinery costs, they are always going up. It's just crazy for both repairs and ownership costs. As far as land charges go, land rents are pretty much flat at this point. Here's a snapshot of a Northeast region budget for wheat. We're using an average of 59 bushels. That's a 7-year average where we throw up the high and the low. Our prices come from Dr. Olson, and so we're using 578 for this particular region. And then we've got our various costs. Fertilizers higher, of course. Repairs are higher. Fuel is down some. Operating interest is down. Those are the direct costs. You pay those when you plant that particular crop. We also have indirect costs that you're going to pay whether you plant a crop or not. And these are regional averages, okay, for land charge. Land charge, I get some heat on that. Your land rent is too low, and we get that from the North Dakota Lands and Department of Land and Trust Survey, and I think it's low as well. But I can't make up numbers. I have to back up what I put into these calculations. You can see there we've got a negative number there. A lot of these budgets are negative this year. There is a few bright points. Sunflowers, barley look good. There, of course, specialty crops. Better make darn sure you have a contract. Some of those contracts, however, they have limited production amounts that you can contract for. So this is a typical budget. Also, you notice we have machinery depreciation, a non-cash expense. That's something that gives you a little cushion when you're calculating your cash flow. These budgets are available at the NDSU Extension website. At that link there, you go to the Extension page and get to the Ag Hub. There are printed copies in every Extension office for the various regions. We also have this program called Crop Compare I wanted to mention. What it does, it compares various crops, and we're using our budget numbers that we just came up with. And here's just a little snapshot of what it looks like. It's just a simple Excel program. We're using all the numbers that we use. You go and change the numbers to how you like it, and you can choose what we call a reference crop. You can compare wheat to what kind of price would you need to compare this to other crops to get the same total return over variable costs. So that's something you may want to take a look at. We also have Excel files online for our crop budgets where you can plug in your own numbers and see and check out your own situation. There's the link to Crop Compare. Also, I want to mention we have something called Plotting a Course. This is where we have short and long-term planning prices. There's the link there, Ag Plot a Course, I guess, 26. This is just the cover of the publication. You can print this out. There is the main sheet where we've got the historical prices for these various crops, and then a projection into the future, and then our short-term projection. We also have beef cattle, hogs, sheep, and milk for you to look at. These are our planning prices for this coming year. This is what we came up with. Actually, I've got to say that we're gonna have these prices and we're gonna stick with them. Okay, no matter what happens, I guess. I don't know. These are our livestock projections at this point. And so just for you to have some kind of an idea of where, if you're making your budgets, to kind of see where you're at. So with that, we'll entertain questions at the end. I believe Dave would be up next.
Yeah, so just a few comments today about some things that are going on in the biofuel carbon space, which are very important, will have significant impact on ag here in North Dakota. One related to 45Z, which is the clean fuel production tax credit. The other related to the potential for year-round E15 sales nationwide. So looking first at 45Z, the IRS, who's the regulator, released proposed rules on the 4th, so last week, and had a lot of information in there about what might be, as well as a little bit of guidance in terms of what they anticipate is very unique language. And so for those of us in production agriculture, we're really waiting for the details in terms of how will 45Z impact production, which types of practices will be accounted for, how much they might get paid. And really, for the most part, that's all going to be punted until we get a little more insight. Again, this very unique language used by the Treasury and the IRS was saying that they anticipate certain things are going to happen, and then that they'll do certain things in response. So the first one would be to use a feedstock carbon intensity calculator, similar to the one that was released a year ago. Very straightforward, just a couple of practices in it. If that is used, that is available. We have a pretty good idea of what that would mean. Also, we're looking at some changes that were made in the One Big Beautiful Bill. Again, quite a few different parts to that. Again, the Trump administration really drove a lot of this. One was having no negative emissions, which is somewhat challenging. You can have, for most people who do LCAs, you can have negative emissions because you do things that might significantly offset other emissions or actually remove carbon dioxide from the atmosphere. So that's there. Probably the biggest one was no direct land use change. Indirect land use change. This is a really big one because that addition for most corn ethanol refineries put them into a place where they weren't necessarily able to access the tax credit unless they made some changes to get to that number. But by getting rid of the indirect land use change, you put all of the corn ethanol refineries, to my knowledge, into the money. So any incremental change they might make would be able to be incentivized, and really a big deal. And then finally, there was a language about no foreign feedstock for the bill. Again, so possibly using GREET. Again, these are anticipated changes. They anticipate that they're going to use USDA rules. These are actually old climate smart ag rules in terms of record keeping, verification audits, and so forth. And why this is really important to producers, including in North Dakota. As soon as a new proposed rule is made for these carbon calculators for the record keeping, and once those rules are finalized, you'll be able to, the refineries will be able to access these tax credits, but it could be back into fuel produced in 2025. So if you think about what that means, a corn farmer in North Dakota may have used part of his 23 crop, kept it in the bin, and then sold it, and then it was used to make ethanol last calendar year. Again, exactly how that might work, we don't know. We're going to have to do a little bit of legwork to see exactly where we're at again, because this can end up being a relatively sizable amount of money. And really, I kind of put a heads up saying, if you are a farmer or work with farmers who have reduced tillage, no-till, use cover crops, do something with nutrient management with regard to fields that produce corn or for corn production, this could be a relatively sizable deal beginning soon. Again, the tax credit won't be available until those rules specific here to the feedstock are proposed and then finalized. Moving on really quickly to year-round E15, potential opportunity for agriculture. It's currently prohibited. The extension of the Clean Air Act, really prevents the use of E15. There's been waivers the past few years, beginning first with certain geographic regions. Last summer, we actually had a nationwide waiver, so you could sell E15 anywhere in the country. In January, so last month, there was language included in one of the appropriations bills that would have allowed year-round E15 sales. That wasn't included in the bill as it was finally passed. But what was included was the creation of a study group to look at it, with them reporting back in just a few weeks. In terms of binding, it doesn't necessarily mean much, but we'll kind of have to wait and see exactly what might come of that. Again, the idea of having E15 available, increased market, expanded market for E15 for ethanol, potential for increased corn use. A lot of different factors go into what those numbers would actually end up being. This would just be changing the law. It doesn't mean that E15 would be available at your station. It doesn't mean that E15 would be priced competitively in terms of energy content and so forth, but really opening up an opportunity for future growth for a market, that uses quite a bit of corn. So those are my comments, kind of completing the prepared remarks for our group. We do already have a couple of questions, so we'll get to those in just a second. And we will be back in 4 weeks on March 12th for the next edition of the webinar. With that, I think I'll direct a few questions. So the first one, this one's a little bit tough. I think this was directed at Brian regarding segmenting expenses. If you see that question.
So I'm not sure. Let me see if I can do this. If you want to look at what USDA has, one of the better sites is the Farm Income and Wealth Statistics. And so what you're going to do is it's the USDA's Economic Research Service site. You go to Farm Income and Wealth Statistics, that's what you're going to open, and the production expenses. And it's a pretty big spreadsheet, and it can go back a lot longer if you want to. But they break it out by fuels, pesticides, fertilizers, gas, so anyway, it's a lot more expanded upon line item by line item in terms of what's going to be. But I can just tell you, one of the big expenses is equipment. Equipment costs have gone up dramatically. I've been talking about it for the last couple of years. That's been a big one. Fertilizer prices have been high for 2 years compared to the baselines. And depending on what crops you grow, obviously, that's a big one. So speaking general, and I'm just talking about from the crop side, all the increases in livestock costs are because livestock prices are high. I mean, if you're a feedlot or a cow-calf producer, one way or another, you're bringing calves in, and when their prices are high, your input costs are high. So that one's pretty easy. But if you'll just send me an email, brian.parman@ndsu.edu. If you have trouble finding the link, I'll link it to you, and you can download the spreadsheet yourself straight from USDA.
Thanks, Brian. And then Ron, did you see the other question? I thought that was coming up your alley.
I was going to respond to that in the Q&A. Does NDSU have a way to calculate the ARC PLC payments for 2025? Well, yes, I just got done updating the calculator for the 2026 marketing year, which payments are paid in 2027. But I could take our old calculator and update the reference prices and use the old benchmarks. But here's the thing. There's going to be a base update as well. And I don't know if we know if we're going to use the new bases or the old bases for calculating the fall payments. That's still an unknown. And I have no idea how they're going to allocate this 30 million acres more of base either. That's a kind of an unknown at this point. So yes, we could have a simulated calculator for cash flows online, but that's about the best we could do, I guess, at this point until we know more information. So,
thanks, Ron. There's one question for me regarding indirect land use change. And so when you calculate the carbon footprint of a crop, you typically account for how we might change the use of land globally. So, for example, if we were thinking about beginning with, let's say we're going to use another 3 gallons of ethanol, well, I need another bushel of corn. Well, if I need another bushel of corn, where's that going to come from? And the general thought is, well, I'm going to need a little bit more ground to do that. And let's say I have to take whatever that is, whatever was grown there before is going to bump, and it's going to continue to bump until somehow we reach a new equilibrium. What's really tough about this is those models are really, really complex. And for the most part, many of them have been inaccurate. What was done in the One Big Beautiful Bill was, well, let's just get rid of all of that altogether. which is certainly one way to approach it. But again, what you're saying is instead of me growing additional acres to biofuel crops and that having an impact on land use around the world, for example, let's say that leads to additional acres of production in Brazil, which could have greenhouse gas effect. We're just saying, you know what, that isn't part of the equation anymore. And again, why that's really important is because it puts for the most part, to my knowledge, all the corn ethanol refineries into the money. We're not accounting for that additional. Typically, it's an additional piece with indirect land use change, but saying that that's not there. So now the corn ethanol plants, any incremental changes they make, either in terms of how their facility operates or the feedstock, the crops that they use, every way that you can reduce that carbon intensity, you can generate more tax credits. Again, getting right to that incentive, right to those incremental economic benefits. I don't see any more questions. And with that, I just want to thank everybody for joining us this month. We will be back again next month on March 12th. And hopefully between now and then, it's 40-degree weather. Thanks, everybody.